Hello, I'm Stephen from TEFAT, and today I'd like to give a presentation on bank reconciliation, bank rec. Just set up the tripod, make sure everything's in view. Yep. Okay, so a bank reconciliation, firstly my source for the procedures is McGrath and Walsh 95 page 274. I've got that listed later in the source. The idea of bank rec is for a business to compare their cash book, their bank ledger, to the bank statement. And the rule is when we're referring to debits and credits in the workings, that refers to the bank balance, but the final balance is put in the cash book debit and credit stance of the business. So positive cash is a debit in the current assets on the balance sheet, and cash deficit would be a credit if it was a cash deficit. So you have to get used to it because the bank debits and credits are opposite to the business debits and credits. With your bank account, if you've got money in the bank, it's a credit balance to the bank from their perspective, and a debit balance is an expense. From their point of view, you having money in the bank means they owe you money, but if your bank account is in a debit balance, you owe them money, so that's favourable to them. So just get used to the opposite stance, but from our point of view, positive cash is a debit on the current assets and cash deficit is a credit. So you're comparing the bank statement to the cash book of the company, also known as the bank ledger, and you're finding whether the final closing balance is either a debit or a credit from the business point of view. So I'll just explain it. The company compares their records with the bank statement. Checks might clear in a different period. That's why the bank balance of the statement and the cash book might be different. Outstanding deposits mean that someone has paid you, but it hasn't hit the company bank account just yet. And so the rule is we add outstanding deposits if the bank balance has a credited favourable balance, and deduct outstanding deposits if it's a credit balance in the bank account. With unpresented checks, if the bank statement is a credit balance, you deduct or less unpresented checks, but if the bank balance in the bank statement is a debit balance, unfavourable, you add unpresented checks. So if you're asked to do this in an exam, you really have to memorise that parrot fashion if you're not given it. Banks sometimes do make errors. It does happen sometimes where maybe someone else made an error. One of the bank customer inadvertently sent money to the wrong account. Things like that have happened. And bank charges have to be added to the cash payments journal, but they don't go in the bank rec. Only outstanding deposits and unpresented checks go in the bank rec. And similarly, if the bank has paid the company or entity, sole trader, partnership interest earned, that would go in the cash receipts journal, or the bank ledger if they're not using either cash payments journal or cash receipts journal. That maybe they're just using a bank ledger. So as we mentioned, things like bank charges have to go into the cash payments journal of the business, but they're not put in the bank rec. And so you start with the closing balance figure of the bank statement and put that at the top. And there's other anomalies, like maybe the bank doesn't deal with foreign banks if it's a foreign check, and maybe checks bounce, the check writer hasn't got enough funds, government charges and bank fees we've mentioned go in the cash payments journal, not the bank rec. And our goal is to verify if the final bank balance is a cash surplus or deficit, which has to be written into the books of the company: debit for money in the bank, credit for an overdraft. Overdrafts are getting a bit old-fashioned. They probably still exist, but a lot of banks say if you want a short-term loan, get a credit card. So a lot of these old bookkeeping procedures are getting a bit fuddy-duddy sometimes, because overdrafts aren't really common anymore. So these are the steps. Again, the debit and the credit refers to the bank statement balance, not the cash book balance, but the final debit or credit is the cash book balance after the bank rec has been completed. So the first step, and I got this from McGrath and Walsh, as I mentioned, which is in the source at the end of the presentation. You obtain the bank statement. Get a closing balance of the bank statement. Is it a debit or a credit? Credit means, in the bank statement, means money in the bank. Debit is an overdraft. You compare the deposits of the bank statement in the credit column with the cash receipts journal and the cash payments journal, so that those two journals have to be on hand. And I'm dealing with manual bookkeeping, not computerized bookkeeping. So as we mentioned, any deposits not made or outstanding deposit, you add the outstanding deposit if it's a credit balance, which is normally the case, but you deduct the outstanding deposit if it's a debit overdraft balance. And if the bank balance is a credit balance, you deduct any unpresented checks. If the bank balance is a debit balance, unfavorable, you add any unpresented checks. That's the procedure. And you see if the check is, and all the items are in the cash payments journal or the cash receipts journal. So all items have to be identified that might be anomalies, such as unpresented checks and outstanding deposits, and bank fees and charges, government charges on bank accounts, but that's not put in the bank rec, as I mentioned. And notify the bank if you think there's any errors to get clarification. So any bank fees and bank interest paid must be put in either the cash payments journal or the cash receipts journal. Fees would go in the cash payments journal. Bank interest paid would go in the cash receipts journal. And so the procedure is, you've got the balance, the number in dollars, you add outstanding deposits or deduct outstanding deposits in dollars, get a subtotal, get deduct any unpresented checks or add unpresented checks depending on the bank balance, get a new subtotal, and you finally find the closing figure of the bank statement, which is put in the entity point of view as positive cash debit and cash deficit. An overdraft is a credit. So I'll give an example. This is the first example. Boggabri Green Energy Solar Panels Bank Reconciliation Statement as at 30th of September 21. So on that date they thought there was a problem, so they thought they'd do a bank rec. That date doesn't have to be consistent with balance day or financial statements. They can call a bank rec whenever they want. So the balance of the bank statement, either a debit or a credit, it happens to be 7,000 Boggabri Green Energy has got as a credit balance, which is favourable, money in the bank. We add outstanding deposits with a credit balance, but you don't deduct it because it's a credit balance. And we found that there's $500 in outstanding deposits to Boggabri Green Energy. So then because the initial figure was 7,000 and outstanding deposits is 500, the subtotal after that adjustment is 7,500. Then we go to unpresented checks, and there's a deduction of unpresented checks if the bank statement is a credit balance, which is our case, and we just ignore the other example because it's not a debit balance, it's a credit balance in the algorithm. So there happens to be an unpresented check for $1,000. So going along with the methodology, we deduct unpresented checks from the last subtotal, which is 7,500 minus 1,000 gives you a new subtotal of 6,500. Okay, and now we've got a closing balance. That's credit balance from the bank point of view on the bank statement. We've got to put it in our point of view as the cash book, the bank ledger. So that means it's 6,500 rather debit in our books. The bank deals with their bank statements. We don't change that. We've only got control of our cash book, so we get it in our point of view. The business cash book figure is 6,500 debit balance, current account in the balance sheet from our point of view, the Boggabri Green Energy. Okay, so that's the end of the first bank rec. Now the second bank rec, Artarmon Floris, this has got some bank fees and government charges and interest earned, but as we mentioned, they don't go in the bank rec. So we better, I forgot to put that in, so the bank balance, I'll just type that in, 3,300. 3,000 had bank balance of 3,300 and an outstanding deposit of $300, an unpresented check for $120, and an account keeping fee of $5, and a federal government bank levy of $2. There was an interest payment of $7 to Artarmon Floris that wasn't posted to the cash receipts journal. Conduct a bank rec because the bank statement balance doesn't match up with the bank ledger. Add missing entries into the general journal, cash receipts journal and cash payments journal, and the cash payments journal, cash receipts journal and general ledger, or just the bank ledger if you're only using a bank ledger. The bank balance is 3,300, which is a credit item on the bank statement, which is favourable. The bank manager Penny joked that an overdraft hadn't been generated by the bank for years, since 1984, and they just say get a credit card. She cheekily said, do you still do bank recs? Tip: bank charges and interest paid and interest received don't go in the bank rec statement, but journalise the transactions and post to the bank ledger. And I'll get to the whiteboard pretty soon. I may as well do that now before I forget. So that those journal entries would be debit account keeping fee expense. It's a type of expense, and credit bank, because we've got to pay for that fee. And describe it, account keeping fees, put a date. I didn't put a date, but you should put a date and a description. The second one, journal entry, is debit federal government bank levy expense, $2, credit bank, $2. Another entry is interest earned, received by the bank to the Boggabri Green Energy Company. They paid $7 interest, which is a debit bank item because it's incoming cash, and credit interest payment income of $7. Posting that to general ledger, there's one of two ways. Usually companies do have a cash payments journal and cash receipts journal, but a really small company might just have a bank ledger. So with those payments, cash payment journal, the right hand side is outgoing cash, so they're the fees and the government charges. The cash receipts journal, the incoming cash from interest earned, bank, $7 on the debit side, or they might just have a bank ledger, and you put the respective debit and credit items on either the left hand side, debit side, or credit side, the right hand side. Those numbers just happen to balance, but if they don't balance, what you do is you find the missing figure, and that becomes balance brought forward, and in the closing balance, and in the next period it becomes opening balance, balance carried down in the bank ledger for the new period. If it was out of balance, that just happened to be in balance, $7 debits and credits either side. So back to the whiteboard. Just make sure we've got everything. So that's our closing balance in the bank statement, 3,300. You add outstanding deposit of 300. So is that consistent with our methodology? Add. So back here, we want to be really careful. Do we add? We don't want to make a mistake. And add outstanding deposits to figure above if it's a credit balance. Yep, we do add outstanding deposits. Back to Artanum Floris, double check that you've made the correct entry. So we've started the bank rec, and our new subtotal is 3,600. 3,300 plus 300 gives you 3,600, and then you deduct unpresented checks, 120 from that subtotal. So our closing balance in the bank reconciliation is 3,480 debit balance. From our perspective, the cash book, if we were talking about the bank statement, it would be 3,480 as a credit item if you're talking about a bank statement. And my source for that list in the bank rec procedures is McGrath and Walsh Applications of Accounting Procedures Workbook, National Core Accounting Publications, 95, Sydney. Thanks for watching. Stephen from TEFAT, and that's the end of the presentation. Thanks for your attention, and bye.